Hey guys, my name is Julius and I hope you had a good week. So today's video is about one of the strategies that I use and it has been so beneficial during my journey of investing. This strategy is only good if you are a dividend investor. The strategy I'm talking about is called a DRIP or a dividend reinvestment plan. This strategy can be extremely valuable tool for long-term investors looking to maximize the compound returns of their dividend stocks. Now with a DRIP, all of your dividends are automatically invested commission-free into additional shares of the same stock. Even if your dividend payments isn't enough to buy a full share, over time this can have a massive impact on the return of an income investor portfolio, resulting in hundreds or even thousands of dollars in additional gains. Now first let's define what a DRIP is. A DRIP stands for Dividend Reinvestment Plan, and the concept is simple. When stocks you own pay you a dividend, a DRIP automatically reinvests those dividends into additional shares of the same stock instead of just adding cash to your brokerage account. Just like any other strategy, this one also comes with both advantages and disadvantages. Now in this video, we are looking at both the advantages and disadvantages coming up. DRIP investing has some big advantages for long-term investors, both in terms of reducing investment costs and making the investment process more efficiently and effective. Now, there are several key advantages to DRIP investing that can save you money and allow you to invest more efficiently and effectively. First, the strategy of investing lets you buy fractional shares of stock. And this allows you to put your entire dividend payment to work regardless of the share price. As an example, let's say that you own 100 shares of Apple, and at the current price is trading at around $16 per share. Now, at the company's current dividend rate, you would receive around $73 quarterly, which wouldn't allow you to buy even more additional shares of Apple. However, with DRIP investing, your 73 dividend could be used to buy a fractional share of Apple, allowing you to put your entire dividend to work right away rather than waiting until you accumulate enough to purchase a whole share. Now this makes investing far more efficient, particularly in terms of long-term compounding. Now using a DRIP lets you take advantage of an investment concept called dollar cost averaging. Now if you aren't familiar, dollar cost averaging involves investing identical amounts of money into a stock at regular intervals, which is exactly what DRIP investment does. The idea is that when a stock price is low, your investment will buy more shares. On the other hand, when shares are high, you buy fewer shares. Over time, this ensures that you will most likely invest at a better average price than you would if you had tried to time the market. Now, DRIP investment automates the compound process. In other words, you won't have to check with stocks which paid you dividends recently and how many new shares you can afford to buy. All you have to do is just enroll in a DRIP and your brokerage will do the work for you. Now, on the other hand, looking at the negative aspect of this strategy, there are potential downsides to DRIP investment that you should be aware of before enrolling into this strategy. Now, DRIP investing takes away your freedom of choice in how your dividends are reinvested. Now, let's say that my Apple stock just paid me a quarterly dividend, but I feel Apple is too overvalued right now. It's not the case. I'm just using it as an example. Meanwhile, I think some other stock in my portfolio, such as Iron Mountain, is undervalued. If I wasn't enrolled in a DRIP, I could use my Apple dividends to buy more shares in Iron Mountain, since I think it's the better deal right now. Of course, you can always choose to temporarily disenroll in the DRIP when it comes to some expensive stocks, but then that is going to defeat the purpose of automating your dividend investment in the first place. Now, to be perfectly clear, in the vast majority of cases, I feel that the benefit of DRIP investing outweighs the downsides of it. But they are still important to keep in mind. However, if you rely on your dividend stocks for income to cover your expenses, DRIP investing may not be for you. So retirees who invest in dividend stocks specifically for income purposes is a good example of people who should not be investing or enrolling in this strategy. And this is because you need to be able to withdraw your dividends. Now, the bottom line is that drip investing can be a great tool for long-term investors, but that doesn't mean it's right for everyone. Now, it's a smart move to outweigh the advantages and the disadvantages before you enroll in your stocks into a drip. Now, I hope this content is beneficial during your journey of investment. Don't forget to smash the like button and consider subscribing to help this channel grow. See you in my next video.